Alrighty, folks, on Friday, we got a horrible jobs number with June actually coming in with negative 13,000. That is not good. We haven't had a negative print in quite a while. This week, we've got PPI and CPI ahead of us. And finally, we have a Fed meeting in about 10 days or so. We're going to have this conversation with Taylor from Life Goal Investments. Man, how you doing?
Doing great. We're at an interesting time where we've got inflation moving the wrong direction. We got jobs market moving the wrong direction. We got the Fed ready to rock. What the heck are they going to do?
Yeah, well, let's review them in the order so we actually know the jobs data. Actually, I'm actually going to change that. We actually don't know the most important number. We're recording this on Monday, and on Tuesday we will get the yearly adjustment. I'm going to say right now, again, this will be posted after. That number is the most important number, even more than inflation. I think if we get a nasty number larger than last year, it's going to paint the Fed into a corner where 50 is the only option. What do you think of that? How important is that yearly adjustment?
It's just such a big number that people can't comprehend. How do we have 1 million jobs or whatever the number is? 1 million jobs last year was 800,000 jobs. How do we have 1 million less jobs created than we had thought? And what does that say?
Where did they go?
That's it. It's like, what happened here? How are we so far off? And we just went back and just saw a negative revision into negative jobs growth for the month of June. So you may see, lots of big numbers getting thrown around. That headline's going to scare people. And the jobs data is already showing up right on the verge of negative jobs growth, which is when people start to talk about the R word.
Yeah, no, they'll be screaming the R word, right? Recession. So again, I think the number that comes out tomorrow is important. If it's greater than last year, and again, Goldman Sachs or JP Morgan is calling for 950 negative. So it's a big number. Let's move over to the other important numbers this week. Inflation. We've got PPI and CPI. Does one or the other kind of stand out to you as the most important?
I think CPI is always more important just because that's what's felt at the end of the day, and that's what's dictated by the Fed, or what dictates the Fed and what they do, right? Core CPI or PCE, but that's closer to CPI than it is PPI. PPI is producer price index. That can give you a little bit more forward thinking as to, okay, what is the manufacturer, for example, paying to input steel or whatever it is? And then what will that then mean for CPI in a month or two down the line? So I always see CPI as being the most important, more important than PCE, because CPI always comes out earlier in the month. And then people can back into what PCE is based on CPI.
Yeah, once you have CPI and PPI, it's been pretty well proven that you can calculate PCE to within the second decimal point. So even though PCE won't officially be out for 2 weeks, that they'll have enough PhDs cranking that number, so they'll know PCE within a factor. I agree with you. I do think historically CPI core was the most important number, just so we can get the expectations out of the way. Expectations are 3.1, which is flat month on month. So that will be important. I will tell you the most important number nobody's talking about is actually PPI, because I think PPI is giving us some really, I'll call it a red flag around services. And everybody missed it last month. Buried inside PPI was, I think in services were like 3.8 or 4.1 or just some nasty number. And that's a big part of our economy. So I'll be looking deep inside PPI, because I think CPI it's just noisy right now, right? With tariffs and these things. And as long as it's flat, it's a non-event, right? Yeah. But services could be a problem inside PPI.
I just can't make sense of it, right? So if you look at services PMI, services inflation. So what you're thinking about there, broadly speaking, is the cost of labor. The cost of labor increasing, but you're not seeing any hiring right now. So it's in the labor force participation is coming down. So I can't get what's driving that. Okay, if we have this number where we're willing to essentially pay people more, the cost of labor is higher, but yet no one's getting hired. You're starting to see layoffs leak through, and labor force participation is off. Unless you're just saying at the end of the day that it is a demographic shift, and that's what's causing just baby boomers to retire, and therefore the numbers can make sense in that vein. I don't get it otherwise. So therefore, I don't think it can persist.
No, I agree. And that's why That's why I have to watch it, because last month was the first time services stood out as basically the cause of PPI rising was services. So again, hopefully it goes back. Hopefully it was noise, right? These numbers are noisy. You shouldn't take any one number. You should look at trends. And that's what I'll be looking for, right? Do we get that follow through? And then we have, to your point, how? I mean, what the hell is going on, right? Are we paying people to stay, right? What are we doing? But yeah, that's the one I'll be looking at. And then let's get finally to the Fed meeting, right? The Fed, has last month, in case people, or last meeting, I should say, we had 2 dissents. I think it was Michelle Bowman and Christopher Waller, both dissent. They wanted to cut, and they didn't cut. They paused. What do you think happens this time?
Yeah, well, we both are in agreement that they should have cut last time.
Correct.
We should have been a cut. We should have cut in July, and I was actually differently than you. I was on board with cutting even earlier on in the year, and to be honest, there took some forward-looking thought process there, which is not what the Fed does. So I never thought they were going to cut, but I said they should cut, which is 2 different thoughts. So yeah, we're going to get 25 basis points. I did not think about I have thought about 50 basis points. I have not thought about 50 basis points in the vein that this lines up so well with what last year took place, where you had the big revision downward jobs, and that caused this bigger overarching concern about the jobs market weakening. And that's what caused a 50 basis point cut. I think there's a ton of logic to you kind of beating on that. I think it brings them in line with where, I don't know if this is an additive or a headwind, a tailwind with what Trump wants to do. Again, I don't know if that's him barking and bickering. I don't know if that makes it more likely or less likely to play out, but at least it comes in his direction some. So I think 50 is not off the table. I think you're right. If we get a nasty number, it wouldn't shock me. It lines up really well with what played out last year. Yeah.
So let me ask this question. Let's assume the number is muted. I don't know, call it 700. So it's not worse than last year. Do you think 50 is talked about at all, or you just think they default to a quarter?
Default to a quarter. The last thing they want to do is shock the market. I mean, you have to realize that the market is at all-time highs right now. Like, we're talking about recession, right? We're talking about negative jobs growth. We're talking about recession, and the stock market is literally at all-time highs. So it's like another
gold at an all-time high.
Yeah. So, but it is interesting is the fact that and Bitcoin has been a really good leading economic indicator for the stock market, or maybe not the economic indicator, but a leading indicator for the stock market is Bitcoin.
Indicator,
is off the boil. From 120 down to, I don't know where it is, 110 or something like that.
111.
I'm wondering if that's an indicator of something to come in the stock market, or if that's some wonky short-term noise that I'm not a Bitcoin aficionado and I don't know what could be causing that.
Well, let's talk about the stock market, because again, one of the things that I'm looking at, to your point, all-time high, again, as an outsider, you're the Wall Street pro, not me, but it does look like Wall Street generally has been selling and retail has been generally buying, kind of buy the dip mentality. Retail's been taught, man. They've learned this buy the dip thing. And it looks like Wall Street's selling and retail's buying. Am I looking at that right?
No, you're 100% correct. Yeah. And for the record, that's been the case for a while now with valuations where they are. As you've had the smart money, and again, in hindsight, this actually looked like dumb money.
Exactly. They've been on the wrong side.
Right. Not continuing to buy hand over fist, but you have retail piling into the market. It's funny, if you bifurcate the market based on high and low quality, so you look at things like return on cash flow, return on equity, debt to equity on a balance sheet, et cetera. If you look from the April lows till today, this is one of the largest divergences we've ever seen, and it's the junk on top. So crappy companies are in this ultimate magnificent rally. You see them about 60 to 70% based on, what, criteria you're looking at when you're qualifying quality or low quality. The junk has massively outperformed. And we'll see if that continues. But smart money, quote unquote, does not buy the junk. So that's retail flow.
Yeah, the thing that I'm looking at is somebody who saw the debt market blow up last time in the GFC is we're seeing the spread between A paper or AAA paper and junk is as thin as I've ever seen. Is that true?
Yeah. It is. Yeah. Wow. You have very thin, what they call credit spreads, and credit spreads are something they look for the smart money. So it's not to say it's smart money, quote unquote, smart money is not buying. They're just not buying, equities hand over fist. They're buying the debt markets, et cetera. And we'll see if that continues to play out. But that is more of an indicator of how much risk is being perceived by folks that are supposed to be intelligent in the space. Because when you are issuing debt, you are going out to the market and saying, hey, I want someone to finance this. Whomever's on the other side of that has to come back and give you a rate. And that is their indication of how much risk they perceive you have to default on that bond. So if credit spreads are really thin, that means that the folks on the other end issuing the debt or taking down that debt think that the economy is in good shape and that company is in good shape, because otherwise they would require a higher payment on the interest, and they're not showing that right now.
Wow. The other thing I've just noticed, and again, this just came to me, this weekend when I was reading news, is the M2 money supply is growing again, right? There was a time where M2 money supply was contracting. It's back to growing at record highs. What does that tell you?
It's interesting. M2 generally works on a bit of a lag. So one of the things that people were saying, to a mind-numbing echo chamber level was, after we had the big rate movement higher, is M2 is coming to a dramatic halt, et cetera. And it just never proliferated in the market. And how much does that lag? I think that's one of the things that's really up for debate right now, because M2 money supply, if you look at nothing else being the only criteria, historically has been a very, very good buy-sell criteria. The question that's out for debate right now is how much is the lag?
Gotcha. It's great to know. Taylor, where can people find you?
Yeah, find us at Life Goal Investments. We're on Instagram and on TikTok, putting out daily videos.
You're amazing, man. Take care. Have a great week.
Thanks so much. You too.